Hey guys, what's up? I'm Erin and welcome back to the channel. When people talk about withdrawals in retirement, inevitably the 4% rule comes up. It's been called the gold standard. In the first year of retirement, you take 4% of your portfolio, adjust for inflation each year, and you should never run out of money in retirement. But here's the problem. In the real world, most retirees end up finishing with far more wealth than they ever started with. That's not necessarily bad, but it does mean that retirees are living more conservatively than they need to. So what if there was a way to capture more of that upside without increasing your risk of running out of money? That's where Michael Kitces' idea of ratcheting withdrawals comes in, a strategy that gives you a raise when the markets go your way. So let's break it down step by step, including a detailed example. You know I love examples, as well as an approach that works the exact opposite way, where you start with a higher withdrawal and are willing to make cuts in retirement. We'll finish it up with a list of pros and cons and the risk associated with each plan so you can decide if it's something that you want to apply to your life. Let's start with the baseline. The 4% rule says withdraw 4% of your portfolio in the first year of retirement. After that, you adjust the dollar amount each year for inflation. So if inflation is 3%, your $40,000 withdrawal in year 1 becomes $41,200 in year 2, and so on. It's safe because it's based on the worst 30-year periods we've seen in the US history, but it's also kind of rigid. If the market performs well, you don't adjust your withdrawals for that. You simply take your inflation-adjusted withdrawal year after year. That's why studies show that about 96% of the time, retirees using the 4% rule actually end retirement wealthier than they started. It is ultra safe, but potentially too conservative. What is ratcheting? Michael Kitces asked a powerful but simple question. What if you could give yourself a raise in retirement when you're far enough ahead? Here's how his ratcheting framework works. Start safe. You begin with the standard 4% withdrawal rate. Adjust each year for inflation. This gives you the same conservative baseline as the traditional 4% rule. Then you have a trigger threshold. If your portfolio grows to 150% of its starting value after withdrawals, so if your $1 million nest egg grows to $1.5 million, that's the signal you're well ahead of plan. Raise size. When that trigger is hit, you permanently increase your withdrawal by 10%. From that point on, you continue your normal inflation-adjusted withdrawals right on top of this higher base. Frequency limit. To avoid overspending in short-term bull markets, you can only ratchet once every 3 years at most. And finally, fail-safe measures. If your portfolio never reaches that 150% cushion, the strategy collapses back to the plain 4% rule. The key here is that the raise is permanent. It layers right on top of the inflation-adjusted withdrawals you were already taking. And that's the whole point. It recognizes that you're ahead and you don't want to leave too much money on the table. You lock in a higher lifestyle, but only after the market has given you sufficient room to do so. Let's walk through how this looks in practice. Imagine you retire at 65 with $1 million portfolio. Year 1, you withdraw $40,000, and we'll assume inflation is 3% a year. Years 1 through 4, you take your inflation-adjusted withdrawals. By year 4, your annual withdrawal has risen to about $43,700 due to inflation. By that time, your portfolio also crosses the $1.5 million mark. That's the 150% threshold. This is your trigger hit. You permanently increase your current withdrawal by 10%. So instead of $43,700, you bump it up to about $48,000. From that point on, you keep adjusting for inflation, but now it's off the new, higher $48,000 baseline. If you were to graph it, you'd see 2 lines. With the standard 4% rule, there's a gradual increase based on inflation. The ratcheting rule would follow a similar path until the trigger was hit, at which point you'd see a large step up, locking in a higher withdrawal permanently. Over a 30-year retirement, that step up can easily mean tens, if not hundreds of thousands of dollars in additional spending. But here's the key. In bad historical periods, like if you retired in 1966, the portfolio would never reach the 150% threshold. In that case, the ratcheting rule looks the exact same as the plain old 4% rule. That's what makes it so powerful. It allows you to capture the upside without exposing you to any more downside. So how does this actually play out in history? Kitces has tested the ratcheting rule over dozens of different historical retirement start dates, and here's what he's found. In many favorable return sequences, ratcheting produced equal or greater lifetime spending compared to the classic 4% rule. And this is because retirees were able to lock in permanent raises when the markets were strong. In bad sequences, like the 1960s or the 1970s, the portfolio never hit the 150% threshold. In those cases, the ratcheting approach simply collapsed back to the traditional 4% rule, so those retirees were no worse or no better off than following the traditional plan. To put some color to this, a retiree starting in 1966, right before a brutal stagflation decade, would never have been far enough ahead to trigger a ratchet. Their withdrawal would have looked identical to the plain 4% inflation-adjusted path. Someone starting in 1973, right before another tough market, also would have seen no ratchets triggered. Again, they would have been protected simply by defaulting back to 4%. But if you retired in 1982, right before one of the greatest bull markets in history, your portfolio would have skyrocketed. In that environment, you would have hit the ratcheting threshold multiple times, locking in withdrawals that far surpassed what would have been allowed with the traditional 4% rule. That's the beauty of this approach. In weak markets, it's just as safe as the traditional approach. But in strong markets, it allows you to spend more of your money while you're alive instead of leaving it behind as unspent upside. Let's start with a very specific case study. A retiree with a $500,000 portfolio retiring in 1982, and we're going to track a 30-year retirement through 2012. Yes, I am deliberately picking one of the best start dates in market history because this is where the ratcheting rule truly shows its power. If we were looking at a poor performing market, we might never hit the thresholds to trigger a ratchet up in spending, and in that case, it would look like the plain 4% rule. The bull market era is where this ratcheting strategy really shows its power. So first, let's do the classic 4% rule. The starting withdrawal in 1982 is $20,000. The withdrawals increase each year by the actual CPI inflation. Withdrawals are taken at the start of the year, and the remainder in the portfolio captures the market return for that year. The total withdrawals from 1982 to 2012 would be just over $1 million. The ending balance of the portfolio in 2012 would be about $8.4 million. So despite 30 years of withdrawals, this retiree would end with wealth that was 16 times their starting point because they had those really powerful bull markets of the 80s and the 90s, and they even survived the dot-com bust and the 2008 financial crisis. Now let's apply the ratcheting version of the rule. We have the same starting 4% withdrawal, $20,000 in year one. Withdrawals increase each year with inflation. Anytime the portfolio ends the year at more than 150% of the starting balance, so $750,000, and it's been at least 3 years since the last ratchet, the next year's withdrawal gets a permanent 10% bump on top of any inflation adjustments we've already experienced. The results in this situation, the total withdrawals over this retirement, about $1.7 million. The ending balance, about $7.1 million. The ratchet rules were triggered 10 times over the 30-year period. Compared to the classic 4% rule, which produced about $1 million in lifetime withdrawals, the ratcheting strategy produced about $1.7 million, roughly 70% more lifetime income, while still leaving behind over $7 million. And that's the point. In strong market conditions, the retiree wasn't forced to remain ultra-conservative. They were permanently able to increase their spending 10 times over this 30-year retirement. The trade-off is that their ending balance of their account is smaller than what it otherwise would have been with the traditional 4% rule. In this case, it's still quite large though, and the main point here is that they got to spend more while they were alive. Let's look at what the draws on these portfolios would have looked like over time with these two strategies. You can see right away that both strategies start in the same place, $20,000 in year one. But over time, the gap widens dramatically. By the midpoint, around year 15 to 20, the ratcheting rule is already providing withdrawals that are 30 to 70% higher than the classic 4% rule. By year 25, the difference is striking, roughly $42,000 under the classic rule versus over $80,000 under ratcheting. And by year 30, the gap has more than doubled, just under $47,000 a year using the 4% rule, compared to nearly $110,000 with the ratcheting strategy. The big takeaway is that ratcheting doesn't just give you a little more, it can completely change your lifestyle in strong market environments while still keeping the safety net of the 4% rule in down markets. Let's talk about the pros and cons, or the risks, of ratcheting. Now, this all sounds great, but as with any strategy, there are benefits and there are caveats you have to know. Ratcheting lets you enjoy more of your wealth in strong markets instead of leaving behind large unspent balances. It's more protective than simply saying, hey, I'm going to spend more because the markets are up, because you only ratchet when you're well ahead. The rules are simple, they're easy to implement, and they blend safety with flexibility. The frequency limit helps to smoothen out volatility, and behaviorally, it feels rewarding. Retirees get to enjoy the upside in good years without feeling like they're hoarding forever. Now, of course, there are risks. That 150% threshold, the 10% increase, and the every 3-year mark, these are kind of arbitrary benchmarks. So what if you decide to take these rules and tweak them? What if you set your ratcheting thresholds too low? Maybe you set it at 120% of your portfolio balance, or you try to allow yourself to ratchet every year or two. This can lead to overspending and depleting your portfolio too quickly. In a long, flat, or a weak market, you may never ratchet at all, and so this portfolio doesn't end up performing better, it simply defaults to the traditional 4%. As I just said, that 150% threshold and the 10% bump are somewhat arbitrary. Just because they've worked historically does not mean they're optimal for the future. You might set a different threshold or choose a smaller bump, like 5%, depending on your comfort level. Another important caveat, once you ratchet your spending up, that increase is permanent. What if the markets crash after that and you feel like you're spending at an uncomfortable level? Well, now you can reduce your spending, but you're going to do it manually and we're back to guesswork. What if inflation is really high at the same time you're ratcheting up? That math might get a little bit tricky. And of course, we have the caveat that maybe 4% withdrawal might even be too risky in some environments going forward. Remember, the 4% rule is based on historical markets, and while it has survived every bad period we've ever seen, there's no guarantee it will survive every bad period we might see. The bottom line is that ratcheting can be a smart enhancement when we have strong markets. However, no withdrawal strategy is perfect. Now let's flip the script, because Michael Kitces has a strategy that appears to be almost the exact opposite of the ratcheting approach. This strategy is called the dynamic spending with small permanent cuts. With this strategy, you're essentially willing to make small permanent cuts to your withdrawal. The trade-off here is that you get to start with a higher rate of withdrawal, and if the market performs poorly, you're willing to make these cuts, but you only have to make them if the market performs poorly. Here's how it works. You start with a slightly higher withdrawal rate, maybe 5 or even 6% instead of 4%. After any negative market year, you permanently reduce your spending by about 3%. Cuts are one way though. Once they're made, you don't restore spending even if markets recover later. This approach allows you to begin more aggressively, but repeated downturns can have a compounding effect on your cuts. Starting at a higher rate of withdrawal could be very attractive. Many retirees tend to spend the most in their first years of retirement, whether that is just an active lifestyle, more expensive activities, or travel, and then spending tends to naturally taper over time. In that case, starting with a higher spend rate and being willing to taper if markets demand that might better align with true retiree spending. But the key trade-off here is discipline. You have to be willing to accept those cuts if the markets underperform, and those cuts are permanent. The idea here is that the permanent cuts slowly recalibrate your lifestyle to a lower level if markets disappoint. Unlike guardrails, where spending can move both up and down, or ratcheting, which only moves up, the permanent cuts model is deliberately conservative. You only ever move down. If you retire into a strong market, you might never have to make a cut and you could enjoy higher withdrawals for your entire retirement. Alternatively, if you retire into a down market, you might be forced to make multiple cuts in a row, and that might feel really uncomfortable. These aren't hard and fast rules for the initial withdrawal. It's not like the 4% rule. You could think of it more like a framework. So you could pick a higher starting withdrawal, one that you're comfortable with. Maybe you go with 4.5, maybe you go with 5, maybe you go with 5.5. Heck, maybe you go with 6% as a starting rate. But the higher you start, the more risk you're introducing, the more aggressive your strategy, and the more likely you're going to have to taper your cuts if the market performs poorly. Likewise, that 3% cut after a down year isn't a hard and fast rule. It's more of a guideline. If you want to make a more aggressive cut or a lesser cut, you can do so if that aligns with your flexibility. But just know there's guesswork here. Compared to the classic 4% rule, this approach carries more risk of depletion. You've got a higher starting draw, you're pulling more out from day one, and this is leaving you with less of a cushion if you run into a poor performing market. It's reactive, not preventive. Cuts happen after the damage has already been done to your portfolio, so you've already locked in some of the losses. And be aware of compounding cuts. Multiple down years or multiple bear markets can send spending downward and put a lot of stress on a portfolio. That said, the intent is to balance things. If the markets are strong, you enjoy more comfort early on. If the markets are weak, you gradually self-correct, which helps avoid catastrophic depletion. The bottom line is this isn't a free pass to spend 5% or 6% forever. You gain more lifestyle in the good times, but you are more vulnerable if the market turns to a poor performance. Michael Kitces and Wade Pfau's backtests show that permanent cuts can increase failure risk if markets start weak, because you're drawing more heavily in the vulnerable early years. But in strong market sequences, you may never trigger a cut. So this means you lock in a higher lifestyle without ever having to pay a penalty, but the performance depends on the sequence of returns you capture. This strategy also comes with a behavioral test. Are you comfortable with your lifestyle ratcheting down if markets are rough? For some retirees, especially those who have a higher percentage of their spending triggered by discretionary, maybe travel, something like that where you can easily make an adjustment, this may feel entirely doable. For others, permanently reducing purchasing power can be emotionally difficult. One more nuance, if inflation is high at the same time markets drop, the pain can be double. Your nominal withdrawal is cut just as the cost of living increases. That's why a 3% cut is a guideline, not a rigid rule. Imagine you retire with $1 million portfolio. In the first year, you draw $50,000, a 5% starting rate. But in year 2, the market drops. Following the rule, you trim your spending by 3%. So your withdrawal falls to about $48,500. If the downturn keeps coming, those cuts compound. After 3 consecutive bad years, your income would be reduced by almost 10%, down to roughly $45,000. Here's the key. If the market rebounds later, your withdrawal doesn't bounce up. Each cut is permanent. Over time, that means your spending gradually ratchets down if the markets underperform. This is good from the standpoint of protecting long-term sustainability, but it never restores your purchasing power. Compared side by side, the differences are clear. The plain 4% rule is a steady but conservative approach, giving you predictability but often leaving behind large unspent balances. Ratcheting keeps you steady most of the time but allows permanent raises when you're far enough ahead, letting you capture more upside without risking downside safety. Permanent cuts flip the script. You start out with more, but you risk locking in a lower lifestyle later if the markets disappoint. So which is better? Ratcheting's more cautious. You only ever move up if the market warrants it. Permanent cuts is more aggressive. You get to start with a higher withdrawal, but you risk lifestyle erosion or purchasing power erosion if the market performs poorly. At their core, both strategy is introducing flexibility. They move away from the rigidness of the 4% rule and try to base withdrawals on actual outcomes of the market. Which one is best? Depends on your personality. If you value safety and only ever want to ratchet up, well, then the ratcheting approach might be a better fit for you. But if you want to front load your retirement and you're willing to tighten your belt later if the market warrants that, well, small permanent cuts might be a better fit. And it's worth noting that these aren't the only tools in the toolbox. Other frameworks like guardrails or spending ceilings and floors also give retirees ways to adjust over time. The bigger lesson here is that dynamic withdrawal strategies are more reflective of reality rather than following a single rigid rule. The 4% rule is a useful starting point, but it is inflexible. Ratcheting says, when you're ahead, lock in a raise. Permanent cuts says, start higher, but accept trims if the market demands it. Neither is perfect, but both offer a way to adapt, and being adaptable is really what creates a sustainable retirement plan. You don't have to be chained to one number forever. Your withdrawal can adapt to the markets and your life. What is your plan? Do you have a withdrawal strategy that you are planning on following as you go into retirement? Share your thoughts in the comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. The ratcheting rule, that was like bursting into song. No, we're not going to do that. I don't think anybody needs to hear it. Historical retirement start dates. Kitces, I really do want to meet him. Does anybody know him? Hi, I'm Erin. I would love to meet Michael. Sorry, I started thinking we were drawing 4%. I'm like, oh my gosh, it'd be way higher. We started with 20,000. Sorry. So I get so anchored to the $1 million examples. There was no way I was going to put $1 million portfolio in 1982. I could just envision the comments, which would be fair because who had $1 million in 1982? Not many of us. I wasn't even alive yet, so certainly not me.